For decades, the whole narrative around home ownership, it's been framed exactly like a marathon.
Oh, absolutely. The ultimate endurance test.
Right. You train, you save up, you push through that grueling paperwork, the credit checks, the bidding
Like
wars.
an heartbreak of losing out on 3 houses before you get one.
Yeah, exactly. But then finally, you cross that finish line, the lender actually hands you the keys, and you take that deep breath and you think, you know, I made it. I am finally secure.
There's this really profound psychological comfort in that specific moment. Society essentially tells you that the hard part is over.
Right, you've won.
Yeah, we've secured your shelter, you've locked in your living costs, and now you can just sort of ride off into the sunset of the traditional American dream.
But, and this is a massive but,
Yeah.
when you actually dive into the numbers of what it takes to survive inside that house today, that finish line illusion, it completely shatters.
It falls apart entirely.
It really does.
Yeah.
For a lot of people listening, qualifying for the loan isn't the finish line at all. It's really just the entry fee. The real crisis right now is trying to afford to keep the house once you are standing inside of it.
Keeping the lights on, keeping the roof from caving in.
Yes. Okay. Let's unpack this. Because today, we are going on a mission to uncover a massive blind spot in the modern American dream.
A really dangerous blind spot.
We are looking at the realities of the housing crap. And we're drawing from Naomi Emanuel's really extensive research in the 10-part series, The 99% Perspective. Specifically, we're focusing on Article 3, the housing trap.
It's such a crucial piece of work.
It is. Our goal for this deep dive is to break down the specific, skyrocketing annual non-mortgage expenses that are currently trapping families and making homeownership incredibly difficult for you and everyone else out there.
We really need to fundamentally shift our mindset here, because the national conversation, it's almost entirely fixated on high interest rates.
Right, the rates and the initial purchase price?
Exactly. It's all about getting a foot in the door. But we have to look past the closing date. The crisis isn't just about the inability to buy anymore. It's about the inability to maintain.
Because the house isn't just like a static object sitting there.
No, not at all. It is a constantly decaying physical structure, and it requires this relentless financial fuel just to remain habitable.
Relentless is the perfect word. Because once you get those keys, year one begins. And this is where we have to confront some truly staggering data from the text regarding the 2025 bank rate estimates.
The hidden costs.
The hidden costs. We are looking at an average hidden cost of owning and maintaining a single-family home right now of roughly $21,400 per year.
I really want everyone to just let that number sink in for a moment. Over $21,000 a year.
And that's not the mortgage.
Right. That does not include a single penny of your mortgage principal. It doesn't include your mortgage interest.
Wow.
That is entirely separate cash that has to leave your bank account every single year just to exist in that space.
It feels a bit like buying a house right now is like buying a heavily discounted printer.
Oh, that's a great way to put it. The printer trap.
Yeah. The upfront cost is a hurdle, sure, but it's the constant, unavoidable cost to the ink. The maintenance, the utilities, the taxes. That's what actually bankrupts you.
What's fascinating here is that when we break down that $21,400, we aren't talking about luxury renovations.
We're not talking about a new debt.
No, these aren't people installing marble countertops or adding a sunroom or putting in a swimming pool. These are bare survival costs.
It's keeping the house standing.
Keeping the shelter functional and legally compliant.
So let's look at the actual anatomy of that number. Because Emmanuel's brief breaks it down. Maintenance alone is estimated at $8,808 a year.
That's a huge chunk right there.
Then you have utilities and energy coming in at $4,494.
Right.
Property taxes average out to $4,316. Home insurance adds $2,267.
And it keeps going.
Yeah, even internet and cable, which, they function as basic utilities in the modern digital economy, they tack on another $1,515.
And taking a closer look at that maintenance figure, the one that's over $8,000, it becomes really clear why these hidden costs turn a seemingly stable family budget into a full-blown crisis.
Because you can't just ignore them.
Exactly. Think about the reality of physical entropy. You've got a roof replacement, or a dead HVAC system in the middle of January.
Oh, the worst.
Or a burst pipe inside a wall. These are not optional upgrades that you can just put off until you get your annual bonus.
Right, it's not a fresh coat of paint.
If you don't fix a failing roof, water destroys the drywall. Then it breeds mold. And suddenly, the house literally becomes uninhabitable.
So families take these carefully planned budgets, which, they look perfectly sustainable in their mortgage applications.
Flawless on paper.
Right, and then they watch them get completely blown apart by the sheer physics of owning a building.
Yeah, the physics always win.
Wait, hold on. I need to stop you there, actually,
Yeah.
because this goes against everything we've been taught about house instability.
How so?
Well, if I do everything right, I save my down payment, I lock in a 30-year fixed-rate mortgage specifically to shield myself from inflation.
Holy grail of mortgages.
Yeah, exactly. Shouldn't my housing payment be entirely fixed? How are long-term homeowners, people who've been in their houses for years or even seniors on fixed incomes, getting completely blindsided by this?
So that right there is the core illusion of the fixed-rate mortgage. Your payment to the bank typically consists of two distinct halves.
Okay.
You have your principal and your interest. Those are indeed fixed for 30 years. The bank will not change those numbers.
That's the part everyone focuses on.
Right. But the other half is your escrow account. And this is the pool of money the bank collects from you every month to pay your property taxes and your homeowner's insurance on your behalf.
So the bank is really just acting as a middleman for those other bills.
Exactly. They just collect and distribute. And the crucial distinction here is that those tax and insurance assessments are moving goalposts.
They don't care about your 30-year fixed rate.
Not at all. The mortgage might be fixed, but the local tax assessor evaluates your property value every year, and the private insurance company, they recalculate their risk models every single year.
And they can just raise it.
They can change their rates, and they do regularly. So your supposedly fixed monthly mortgage payment suddenly isn't fixed at all. This dynamic is what the source refers to as the escrow effect.
And the numbers we are seeing on this escrow effect in the brief are just terrifying. Recent data from the National Association of Realtors shows that combined monthly escrow costs jumped 25%.
25%
Yeah.
in a very short window.
They went from an average of $334 a month to $419 a month.
And digging deeper into that combined jump reveals even more alarming specific drivers. Property taxes rose nearly 20%, which is driven largely by inflated home valuations.
Because your home is worth more on paper.
Right. But homeowners insurance spiked by a staggering 41% over the period studied.
41%. I mean, imagine being a senior citizen living on a fixed pension.
It's devastating.
You've paid off half your house, you have zero additional income streams coming in, and certainly your mandatory monthly bill goes up by hundreds of dollars through absolutely no fault of your own.
You did nothing wrong.
You didn't buy a new car, you didn't take a lavish vacation. Your insurance company just decided your house is riskier to cover.
The cost of staying in the home is absolutely not fixed. The loan document is fixed, yes, but the reality of the property is entirely volatile.
And that 41% spike, that points us toward the most aggressive wild card in that entire escrow bucket, doesn't it?
Oh, absolutely, the insurance market.
Because in states facing major climate-related risks, like hurricanes in Florida or coastal flooding or extreme wildfires out in the West, insurance has essentially become a secondary housing crisis operating inside the broader housing crisis.
It really has. It functions as this domino effect that completely destabilizes entire communities.
How does that domino effect start?
Well, first, you have the higher annual premiums, which immediately raise that monthly escrow payment we just talked about.
Right.
But then the market breaks down even further, and that leads to non-renewals. This is where an insurance company looks at their risk models, decides a specific zip code is just no longer profitable to cover, and they just pull out entirely.
They just leave the state or the area.
Exactly. So homeowners are suddenly left holding a mortgage that legally requires them to be insured.
Oh, wow.
And they're scrambling for replacement coverage that is almost always drastically more expensive. And that's assuming they can find it at all.
And even if you manage to keep your policy, the insurers are altering the terms on you. The text points out they are hitting homeowners with much higher deductibles.
Significantly higher.
So instead of, say, a flat $1,000 deductible for wind damage, it might be a percentage of the home's total value.
Right, like 2 or 3%.
Meaning the family has to come up with $10,000 or $15,000 out of pocket before the insurance even kicks in. It just shifts massive financial risk directly back onto the family.
Completely.
But here's where it gets really interesting. We are seeing a massive surge in forced roof and repair updates.
This is one of the most frustrating parts.
Homeowners are trapped in this agonizing paradox where they have to spend, say, $15,000 on a mandatory roof replacement. And this is not because the roof is currently leaking or failing.
No, the roofs might be perfectly fine for another 5 years.
Exactly. They have to do it simply to prevent their insurance company from dropping their policy entirely.
This raises an important question about the balance of power in modern real estate, because private insurance companies are effectively dictating the viability of homeownership now.
They hold all the cards.
They really do. If an insurer flies a drone over your house, which they do now,
That's so dystopian.
it is. They spot some wear on your shingles and they demand a new roof within 30 days. You have no choice.
Because you need the insurance for the mortgage.
Right, because if you drop your insurance or if they drop you, you are in immediate violation of your mortgage terms.
Yeah.
And the bank will then step in to protect their collateral.
What do?
They force place insurance on you at an exorbitant rate. Or worse, they can even begin the foreclosure process.
So it's essentially a financial hostage situation.
That's exactly what it is.
And anyone out there thinking they can just escape this single-family home trap by buying a condo, you are in for a rude awakening.
Oh, condos are getting hit just as hard.
Yeah, condominiums and homeowner associations are getting hit by these exact same insurance spikes for their master policies.
And where does that money come from?
Right. Since HOAs are really just collections of owners, they just pass those skyrocketing premium costs directly onto the residents via higher monthly HOA fees.
Or massive, unexpected special assessments.
Exactly. So whether you are in a detached house or a condo, the dynamic is identical. The institutional risk of owning property in an unpredictable climate is being shifted entirely onto individual families who have absolutely no leverage.
None. They must pay up or lose compliance with their mortgage lender.
Which really begs the question, what happens when a family simply cannot pay up?
That's the tipping point.
Right. What is the human cost when these highly volatile non-mortgage expenses violently collide with everyday life? We move from, sitting around the kitchen table, stressing over a budget spreadsheet to the actual tipping point, losing the home entirely.
And the latest ATM market monitoring data from Q1 of 2026 paints a really grim picture here. Over 118,000 U.S. properties had foreclosure filings in just that one quarter.
1 quarter, wow.
Yes. That represents a 26% increase year over year.
And the deep dive points out that foreclosure starts alone rose 20% annually.
Yeah.
And actual bank repossessions skyrocketed by 45%.
We really have to look closely at the causality here, though. Higher housing costs don't usually trigger a foreclosure in a total vacuum.
Right. People will sacrifice almost everything else before they let the bank take their house.
Exactly. They'll stop eating out, they'll sell a car. It's the pileup. It is the compounding pressure of these hidden costs.
The entry fee just keeps growing.
Right. You have that baseline, $21,000 in non-mortgage survival costs. Then you factor in the 25% jump in escrow, driven by that 41% spike in insurance.
The margins just vanish.
A family stretches their budget to the absolute breaking point just to absorb those increases. And then a normal life event happens.
Like what?
A medical bill from a broken arm, a sudden job loss, a corporate restructuring that reduces someone's hours at work.
So the danger isn't just a high property tax bill by itself. It's when those relentless property taxes and emergency HVAC repairs collide with consumer debt or a temporary loss of income. The family simply runs out of cash.
The buffer is gone.
And Niambi Emanuel's research points out very clearly that this compounding pressure hits certain communities disproportionately. For example, looking at the black-white wealth gap from the text, historical factors mean Black households often enter homeownership with less inherited wealth.
Right. Lower initial home equity and smaller emergency savings cushions.
Exactly. So when a massive insurance spike hits, or a major system in the house fails, there just isn't that generational safety net ready to absorb the financial blow. We're impartially reporting what the source lays out here, and it's a stark reality for many.
It is. And if we connect this to the bigger picture, we arrive at the core thesis of the housing trap. The housing trap ultimately becomes a wealth trap.
Explain that. Because we're always told a house is your best wealth-building tool.
Right. Well, for a home to actually build wealth over time, your income needs to outpace the cost of keeping the shelter operational. You need to have enough margin left over every month to save, to invest, and to actually pay down the principal balance.
You have to be moving forward.
Yes. But when just keeping the home functional, heated, and legally insured consumes every single dollar of a family's disposable income, the home ceases to be a wealth-building asset.
It becomes a liability.
It transforms into a massive liability that actively drains generational wealth.
Yeah.
You are paying significantly more year after year just to stay in the exact same place.
It's incredibly frustrating. I mean, imagine the sheer anger you must feel if you are listening right now and dealing with this exact scenario.
Oh, I'm sure many people are nodding their heads right now.
You are doing everything right. You were working hard. You bought the house like society told you to do. And then you go online and see financial gurus telling you to just, skip the daily coffee.
Or cancel your streaming subscriptions.
Yeah. Or meal prep, better to balance your household budget. How insulting is it to be handed personal budgeting tips when your required homeowners insurance just spiked by 41% and your property taxes jumped 20%?
It's absurd.
You simply cannot budget your way out of a systemic crisis.
You can't. Individual budgeting cannot fix a systemic pileup of hidden rising costs. We have to look at structural solutions here.
It's bigger than one family spreadsheet.
Much bigger. This is fundamentally a public policy issue, not a personal finance failing on the part of the homeowner.
So let's explore those structural interventions that could actually provide real relief, as outlined in the brief, because the current trajectory is just completely unsustainable.
It is. Meaningful intervention requires tackling these specific non-mortgage costs at the policy level. First, we need comprehensive insurance reform. We have to stop extreme premium spikes and arbitrary non-renewals that are destabilizing entire neighborhoods.
Right. And next, the text highlights the need for property tax protections, specifically designed to keep seniors and fixed-income owners safely housed as speculative property values inflate around them.
We can't have seniors taxed out of homes they've lived in for 40 years.
Exactly. Another major solution highlighted in this research is the implementation of home repair grants.
This one is absolutely critical.
We need systems that provide a way for owners to maintain these aging structures without having to take on toxic, high-interest personal loans.
Or putting a roof on a credit card.
Yeah, just to put a new roof over their head so the insurance company doesn't drop them. It shouldn't require toxic debt to stay compliant.
Furthermore, government investment in disaster mitigation funding is essential.
How does that tie in?
Well, if climate risks and extreme weather are driving the insurance spikes in the first place, then proactive government spending on regional disaster mitigation directly reduces that localized risk.
Like what kind of mitigation?
Upgrading municipal drainage systems, managing forest health to prevent wildfires, or building seawalls.
Okay.
Lowering that systemic risk at a macro level is the only way to lower the long-term insurance and repair costs for individual families. It all comes back to how government decisions on zoning, insurance regulation, and disaster planning directly determine whether working communities can actually survive these hidden costs.
It's all deeply interconnected.
Very much so.
So, as we wrap up this deep dive today, let's take a step back and look at what we've uncovered. We've seen clearly that getting the mortgage really is just the tip of the iceberg.
It's just the beginning.
The true crushing weight of homeownership today is that $21,400 in hidden annual costs. It's the volatile 25% jump in your escrow account.
The 41% spike in insurance.
Yes, the insurance crisis that is essentially holding homeowners hostage. And, of course, the deeply concerning rise in foreclosure risks when normal, everyday life collides with these unyielding numbers.
The underlying mathematics of the American dream have fundamentally changed.
They really have. And so, for you listening right now, it might be time to take a hard look at your own real estate goals or reevaluate your current homeowner budget with these specific structural numbers in mind.
You have to factor in the escrow effect.
Because the game isn't just about crossing the finish line and getting the keys anymore. It's about surviving what comes next.
And that leaves us with a rather profound question to consider as we look to the future, building on what Emmanuel let out.
Okay, what is it?
If these hidden non-mortgage costs of homeownership continue to rise at this aggressive pace, if keeping a house starts to act less like a reliable financial investment and more like a massive mandatory monthly subscription service that you can never cancel.
A subscription you can't cancel. That's terrifying.
Will future generations eventually abandon the traditional American dream of individual homeownership entirely? Could this intense, relentless financial pressure force a total reinvention of how we live? it's entirely possible we could see society push toward decentralized communal ownership or lifetime leasing models, where all of these devastating hidden costs, as the roofs, the insurance spikes, the taxes are pooled together on a massive scale.
Just to spread the burden.
Exactly, just to prevent the individual family from being crushed under the weight of their own roof.
That is a wild thing to think about, that the financial pressure of maintaining a house could get so high it actually breaks the cultural model of the single-family home.
It's entirely possible if the math doesn't change.
Because at the end of the day, if you survive the marathon and you finally cross that finish line, it shouldn't feel like you've just been handed the bill for the entire race.